Yet, it's continually in the news, supposedly always on the brink of destruction. It's just like everything is always on the edge of going wrong, which is just a bit weird. Why can't it ever work properly without these massive ups and downs? Well, in today's video, we're looking at the real reasons there are housing crashes and why the system is set up that way to continue going through these cycles. Also, for much more deep diving information on trends in the economy and what that means for you, make sure to subscribe to the channel and hit that notification bell. There have been housing market crashes before. As time moved on, housing markets increasingly changed, and with it, wider economic downturns occurred. Let's briefly look at a few big crashes to see this trend. The Great Depression was the breakdown in the US economy in 1929. It wasn't precisely a housing crisis, but it really affected the housing market because in general, economic trouble is when people lose their jobs, banks go bankrupt, and people will not be able to buy homes and take care of them. So home values went down tremendously. In the 1990s, there was another slight contraction in the economy. The housing market fell off to about 8 to 10%. Not too awful compared with 1929 and in comparison with what followed. It was only the lull before the major problems set in, though. Then came 2008. The world financial crisis of that year was so inextricably linked to housing that it goes down in history as one of the worst crashes of modern times. Now, though, it wasn't the economy that was falling to pieces, which caused problems for the housing market. Rather, this time it would be the reverse. Millions would lose their homes. The US economy plunged deep into recession, and the ramifications spread right around the world. Why should housing lie at the heart of all these major economic issues? To understand this, we have to think about how prices for housing are determined, and how these interact with the general economy. The housing prices depend upon two things: demand and supply. That is, when demand increases while supply remains the same, that simply hikes up the price. This is opposed to any time the supply is increased and demand stays put, the price drops. Now let me go on a little more. Suppose demand increases. So the economy is such that the people are making better incomes and the interest rate has fallen. There are more people who would like to buy houses, so demand rises. If the supply of houses remains the same, this increased demand pushes up the price. If the supply of houses increases, say, through construction companies building more homes, and demand remains constant, then prices of homes will drop. The more available houses in the market for sale, the more the price declines due to sellers competing against each other. Given this simple idea of the supply of houses and demand for houses, a housing crash is perfectly well understood. Absent some form of balance between demand and supply, irrespective of source, financial crisis, government policy, the risk of housing markets to extreme price shocks might be significant. Another important reason for house crashes is mortgages. Mortgages have been useful to people in the purchase of homes, wherein one need not pay for the entire price immediately, but instead take a loan from the bank and return it with interest in due time. The ease with which one gets a mortgage and terms and conditions on the mortgage affect demand for houses highly. This makes more people afford houses because mortgages come at a cheaper price when interest rates are low. The result is a greater number of buyers who drive house prices up. On the other hand, an increase in the rate of interest makes mortgages start costing more. Thus, it cuts demand and drives the prices down. In real estate, again, it's the government that is crucial because it regulates access to mortgages. More people can take out mortgages and demand goes up when interest rates are reduced by the governments or requirements for lending eased. When requirements are tightened or rates increased, demand falls. This also can control the demand in the housing market, which enables them to regulate mortgages. That puts them in a position of strength dealing with house prices. Of course, such power is often a double-edged sword. When mortgage requirements become less stringent, demand can rise rapidly, and the price spirals upward. The result, however, could be a bubble burst if people get too many houses to afford. Let's consider supply. The government, by way of determining the rules, controls how many houses there will be. Home builders have to get permission from the government, which is a long process. If the getting of permissions becomes tough or time-consuming, few homes will be built because if the supply is limited, prices go up. If the situation improves and it is much easier for a builder to get the permission required, then supply goes up, prices stabilize or even fall. This is because the builders are influenced by government incentives, such as tax credits. For instance, if the government is providing tax credits for building affordable housing, the builders would have much motivation in building and increasing the supply of such homes. On the contrary, if these credits are abolished, their focus may turn to more expensive projects, and less of such houses will be in supply, hence high prices. But supply and demand can work in some really fiendishly complicated ways. Suppose, for example, that the government decides to relax constraints on mortgage borrowing and construction. In theory, increasing the level of supply and demand symmetrically should not raise prices, but in practice, it just creates a housing bubble, a high price increase from speculation that is self-reinforcing. Housing bubbles come about because of explosive demand, usually further fueled by easy access to mortgages and speculation on the continuity of price increase. People buy homes with the expectation that later they can sell them for a profit. This speculation pushes the prices even higher until it reaches an unsustainable level of bursting point. Eventually, the bubble bursts. Consumers who bought houses at inflated prices can no longer afford the mortgage payments, partly because interest rates increase. The more consumers default on their loans, the more houses enter the supply side of the market, adding to the downward pressure that is placed on the prices. At the same time, demand decreases because potential buyers are unable or unwilling to buy as prices fall. It's a self-reinforcing cycle. Lower prices beget more defaults, leading to even more homes for sale and thus even lower prices. That's what occurred in 2008. So, now what? Are we on the brink of another housing crash? But there are warnings. In fact, the COVID-19 pandemic sent home prices scorching up pretty quickly when people wanted to put their money into shelter with declining interest rates. The rate is rising now, and it is time that the market cools off. There have already been drops in price in certain areas, and a further drop may be expected if people show less tendency to buy. On the supply side, construction is constrained by the constant rise in material and labor costs. Higher costs that have kept supply in check. All this has combined to make for a very uncertain time in the housing market, slowing demand and scarce supply. Behind every housing crash is an interaction of demand and supply, further coupled with governmental regulations concerning mortgages and building. When demand rises too quickly, because access to mortgages is easily available, supply will not keep up, and a bubble forms. Then, if that bubble bursts, so does a crash occur. If you found this video to your liking, subscribe to this channel to get more of the economy's explanations in very simple layman terms. For now, know what's going on.